Hi, Tim Bigham for Delta Derivatives, Option Hedges and Edges, powered by the best option scanning tools on the market today, rbtrader.com, and looking at a market that's trying to find some power either to the upside or to the downside. To quote the talking heads, we're on the road to nowhere. So 2040, certainly that floor on the S&Ps, 2100 or so. Ceiling, we're just chopping back and forth between there. Certainly with the market a little bit weak this morning on some weakness out of China, some lower growth. Once the oil numbers came out, ripped higher briefly, S&Ps went positive, but has sold off since then. So going forward, be interesting to see which side we break out on. I'm obviously a little more bearish than most. I think given the fact valuations, we're looking at almost a 17 PE on a forward basis, which is one of the richest multiples we've seen in a while. Looking at stocks like Pepsi, McDonald's trading at well over, 25 PEs, which, these stocks normally trade somewhere in the kind of, mid-teen levels. So certainly overpaying, if you will, for the fact that you can get into stocks here. And that's really the conundrum here. Stocks trading at a high multiple, but interest rates at, very low levels, 30-year well below 3, the 10-year well below 2. A third of the world has negative interest rates. So that's the trade-off that these low interest rates have created. It's really, a choice, of the lesser of two evils. And it comes down to investing or trading, really. So as an investor, I think you have to be very cautious up at these levels here. Obviously paying, over 17 for stocks has proven to be a recipe for not great returns going forward. But as a trader, really, the valuations, don't matter as much. This is Traders Exclusive, so let's jump in, take a look at some of the trading going on here. And we're really seeing some big option volume come in recently. I think some of the bigger players are really gravitating towards options, especially during earnings season in front of events, and to express a position going forward. So saw huge volume today on Lending Club LC. The June 4 call set up for a very nice, simple calendar spread trade, buying the July, selling the June, only paying about a dime on that with a stock right at the strike price. So the fact that they're overpaying for these Junes, we jumped in and sold those. About 70,000 have traded so far, so massive volume. They kind of left the Julys alone, so that term structure volatility that I always referred to certainly has, provided a very nice edge, and getting in, anywhere less than a dime, defined risk to say the least here. Also looking at some, big unusual volume on ConAgra yesterday. Saw the June 46 calls, which again skewed that normal kind of term structure of volatility relationship. XPO was another one. Before that, we saw QIHU, that's very difficult to say, with a deal, no deal, deal back on sort of trading rationale. So with the deal on, the stock was trading, well above 70, basically 78 was kind of the cash price. When rumors of the deal kind of broke, the stock got hammered, yet the out of the money calls going out in time, ripped higher. Once the deal went back on, you saw that, realignment here. So that's something we took advantage of as well, where the fact that you had the calls up sharply with the stock down sharply simply because of rumors that the deal may break up. We thought it was probabilistically time to take a little position on that, so bought some stocks, sold those calls in a neutral way. Once it realigned, took the trade off. So going forward, that's kind of what we'll be looking at. KHC was one we talked about last week. That one worked out very nicely as those calls in front of earnings. Someone came in, bought a boatload of them. These calls in essence have tripled based on that. So I think options is the way really to play it going forward for a lot of the big traders. So until next time, this is Tim Bigham, and as always in this market environment, keep those position sizes in place and those stops going. Take care.